Good morning and welcome to Financial Friday, your end of week financial update from your credit union.
Hello, my name is Charity Rupp. I am the marketing manager at Untitled Federal Credit Union, and I want to welcome you to another edition of Financial Friday. Today, I want to talk about credit scores. My lifetime, I've had a lot of experience with credit scores, up and down, and what I never really realized when I was much younger is that I didn't understand them. So I've had trouble buying houses, and I've had to fix credit. So I want to give you guys an overview today of what your credit score is, how the credit bureaus calculate everything. So it's always important. It's the most important thing to always pay your credit cards or any of your debt on time. Absolutely, that is your biggest percentage. That is 35%. So I went to buy my house in 2012 and I was very excited. I've always paid my credit cards on time. I had a high rent payment. Of course, I should be able to get a house because the payment will be lower and blah, blah, blah. But my credit score was a little iffy. Well, it was close enough to pass, right? What I didn't understand is that I had too much debt. And that's when I learned the magical term debt ratio. So what credit card companies and housing companies and car companies look at when they're issuing any sort of loan is how much debt do you have? So let me just break it down. If a credit card company, and this is your only credit you have, is $100, they'll give you a $100 credit limit. Groovy, that's wonderful. We're totally excited. You go out to Target and you put $50 on it right away. Well, it's going to ding your credit bureau that you're now at 50% debt ratio. And that's kind of a bad thing. That shows them that you're going to use your credit, and not be necessarily responsible. Where you kind of want to be is that 20 to 30%. So what you would need to do is put a $30 payment, drop it down to $20, and now you owe 20%. That's your debt ratio. That's how they calculate it. So think about it on a bigger scale. Companies will lend you up to $10,000 in credit. You go out and put $5,000 on it. You're right back to that 50%, and that's not where you want to be. $2,000 is 20%. So that's kind of more where you want to gauge. You want to look at that 20 or 30%, because once you start getting into the 40% of your debt that your credit you're using, your debt ratio is going to be a lot higher, and that's going to impact your score. And that impacts your score 30%. Because what they're looking at is how responsible you are with the credit that you've given, right? And the people who are 80 to 90%, that's dangerous. And, at any time something bad could happen and then I could tip you over. So try to be in that 20 or 30% because that is the one thing that you can get your credit score down pretty quick. So that's what happened to me. I had always paid my stuff on time. Everything was great. But when they looked at my debt, I was at 53%. And at that time, that wasn't going to work. So I had to pay it down to under 40%. And once I did that, it boosted up my credit score even higher. I got a much better interest rate, and I was able to get that home loan. So that's 30%. That's one thing you can just right then pay something down, and that credit score is going to go up. Also, length of credit. So I have a very old credit card. It is from Walmart. I got it when I was 23. When things happened in my life, my credit score dropped. All the other ones dropped me, and Walmart credit card kept me. And they dropped me to $50, and I kept that $50 all that time. Every Christmas, I go buy stuff for my kids, then I pay it off, and I kept it. So I've now had that card for probably almost 20 years. It's getting pretty close. Probably about 17 years. And now my credit score has greatly improved. I understand my credit score a lot better. Now I have a credit limit of $7,500 now. I have nothing on that card, but whenever Christmas comes, I put my stuff on there, pay it off. And, it's worked over the years. But what credit companies look at is the length of credit. How long have you had your credit? Now, of course, age cures all things with credit. So that is 15%. So if you have a really old card that you never really use and they don't shut you down, don't close that card because that gives you a lot longer length of history. And that's what they look at. They also look at credit mix. They don't like to see people with only credit cards. They like to see people with credit cards, with car loans, with home loans, with various things. And that's about 10%. I mean, it's a small factor, but it can drive you down a little bit. And of course, there's always that one. There's always like, I don't want you to run my credit, because you don't want to have too many times that your credit's run, especially in credit cards. You go into a department store and they're like, oh, if you get this, I'll get 10%. I always say no, because I don't want you running my credit. But when I'm going out car shopping, I don't want just one place running my credit. And in 45 days, it's not going to impact you because credit bureaus do understand that you're going to shop around, and you should shop around. You shouldn't go to one place and go, well, that's it. I don't want to hit my credit. That is a 10% impact, and that falls off as the years goes by. You don't want to be over 10. But again, if you're shopping for a car or a home, they expect you to shop around. So they're not going to impact or hit you hard on your credit score at all. And still, even if they did, it's 10%. So that's kind of the overview of your credit score. It's 35 is payment history, 30% is amount owed on your credit, and what's lent to you. What will they lend to you, which is again called your debt ratio. 15% is your length of credit history. 10% is a credit mix, and new credit is 10%. I mean, these are all things that, impact your score. But that big one that you can control is that debt ratio. I mean, just be mindful of how much debt you have, and how much is being willing to lend people to lend you. And if you have any questions, we have a great resource called Green Path Financial Fitness. You can give them a call. We'll have that information as part of this video, and they'll be happy to talk to you. Or you can come into any one of our branches and sit down with one of our very knowledgeable staff members, and they'll be happy to help you out and help you get where you want to be. Credit scores, they can impact everything. How much interest you pay, whether you have to put a deposit down. So, my younger life, I had to put a lot of deposits down. Now, nothing, because I learned how to manage my credit score. And if I could think back and just talk to myself 20 years ago, I would have told her, take care of your credit score. Make sure that thing stays up, and you'll learn a lot. My parents didn't teach me about credit scores. They just told me to pay my bills on time and everything will be great. But it's a lot more complicated than that. So again, thank you for joining me today on Financial Friday. And if you have any questions and need more direct help, Green Path is there, and we're there always to help you out. Have a great Friday.
We hope you've enjoyed this week's edition of Financial Friday.